Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories in financial filings. And today we're diving deep into Toll Brothers' latest report, a company that builds luxury homes but might be facing some interesting currents in the market. Did you know that in just 1 year, this company delivered over 11,000 homes? And in the last 5 years, that number balloons to over 52,000, pretty wild, right? If you appreciate getting straight insights from corporate documents like this, make sure you are subscribed. We also have a Discord community linked in the description below where we break down these filings even further. So, Toll Brothers builds these really nice homes, mostly in posh suburban areas, and they've been expanding their reach and even started building more homes without a buyer already lined up, which they call spec homes. By the end of October 2025, they had about 76,100 home sites, either owned or controlled, and they were actively selling homes in over 440 communities. That is a lot of places to live. Now, what does their future look like based on contracts already signed? Their backlog, that is the value of homes under contract but not yet delivered, was sitting at a hefty $5.49 billion with 4647 homes. They expect to deliver almost all of those, about 98%, in the upcoming fiscal year. That gives you a pretty good idea of their immediate future sales. Let's talk about the numbers and how they compare year over year. For the year ending the 31st of October 2025, their total revenue was about $10.97 billion, a slight increase of 1% from the previous year. Home sales themselves brought in $10.84 billion, up 3%. But here is where it gets interesting. The average price of homes they delivered actually dropped by 2% to $960,200. This suggests they might be selling more of their less expensive homes or offering more incentives to get deals done. Looking at new deals signed, the value of net contracts signed actually dipped by 2% to $9.85 billion. Even though they sold more homes, the average price per contract went up by 1% to $990,600. So people are signing deals, but at slightly higher prices for those new deals, even as the homes being delivered are bringing in a bit less. It is a subtle difference, but it hints at a strategy of moving higher priced new sales while closing out some older, potentially less profitable deliveries. If we look at the income before income taxes, it dropped 14% to $1.79 billion, and their net income also fell 14% to $1.35 billion. On the flip side, their backlog value, that is the future sales they've already secured, actually decreased by 15% to $5.49 billion. This is because they delivered more homes from their backlog than they added in new contracts. An interesting trend to watch. Now, this next part is crucial. Companies like Toll Brothers have to set aside money for potential future costs like warranty claims or construction defects. This is their accrual for self-insurance, and it stood at a significant $237.4 million. Auditing this number is tough because it involves a lot of guesswork about future events. They use actuaries, which are like math experts for insurance, to estimate these future costs. The key here is that it is based on historical data and industry trends, but things can always change. The big risk is if claims turn out to be worse than expected, it could really hurt their profits. Then there is inventory impairment. This is what happens when the value of the homes or land they own drops, and they have to write down that value on their books. For the year ending October 2025, they recorded $32.4 million in impairments for operating communities and another $33.5 million for land controlled for future communities. That is a total of over $65 million in impairments from just these categories. They're basically admitting that some of their projects are worth less than they thought or paid for them. This is a direct hit to their bottom line and shows the inherent risks in real estate development where market fluctuations can significantly impact asset values. Let's touch on their land sales and other revenues. This part of the business saw revenues drop significantly, down 56% from $283.4 million to $124.5 million. What happened? Well, in 2024, they got a big boost from selling a single parcel of land for a huge pre-tax gain of $175 million. That kind of off gain clearly skewed the previous year's numbers. So, while the actual underlying land sales might be more stable, the lack of that massive gain in 2025 looks like a big drop. Plus, land impairment charges increased in 2025, meaning they decided to write down the value of more land. Now, let's talk about costs for their home sales. The cost of that revenue as a percentage of home sales revenue went up from 73.4% to 74.4%. This means it is costing them more to build and sell homes relative to the price they're getting. They mention increased incentives as a reason, which is basically giving discounts to buyers. This directly eats into their profit margins. Interest expenses are down a bit, which is good, but the higher costs associated with sales are a clear sign of the challenging market. It's like their profit slice of the pie is getting smaller. Looking at their investments in other companies, which they call unconsolidated entities, they actually turned a loss into a profit in 2024. They had a loss of $23.8 million from these investments. But in 2025, it was a profit of $19.1 million. This improvement is largely thanks to their joint ventures selling properties and bringing in gains. However, they also mentioned that rental property joint ventures often have operating losses initially, building up before they can sell or refinance. It shows they are involved in complex structures with varying return profiles. So what is the bigger picture here? Toll Brothers is navigating a tough housing market. Revenues are slightly up, but profits are down. They're selling more homes than before, but at lower average prices for delivered homes, and new contracts are showing some weakness. The increase in selling costs and inventory impairments are red flags, suggesting they are either discounting more heavily or facing higher building costs that they can't fully pass on to buyers. Their strategic move to exit the multi-family development business by selling off a large part of their portfolio to Kennedy Wilson is a significant step. It signals a focus on their core home building business and a way to potentially raise cash and simplify their operations. While this sale is a positive move towards simplification, it also highlights that this part of their business might not have been performing as well as hoped, or perhaps it was becoming too complex to manage alongside their main operations. The risk factors section is pretty extensive, as you'd expect for a home builder. They're worried about housing market ups and downs, inflation, interest rates, and anything that makes it harder for people to buy homes. Competition is also a big concern, both from other builders and from existing home sales. They also acknowledge that unexpected costs for labor and materials can really hurt them, which we've seen across the industry. Overall, Toll Brothers seems to be managing, but the market is definitely putting pressure on them. They're trying to balance selling homes with maintaining profitability in a world of rising costs and affordability challenges for buyers. The strategy of selling more spec homes might help with speed, but it also means they carry more inventory risk. What is your take on Toll Brothers' latest financial report? Do you think they are weathering the storm effectively, or are there storm clouds ahead? Let us know your thoughts in the comments below. If you found value in this breakdown, please hit that like button. It really helps us out. And of course, subscribe for more deep dives into the world of corporate finance. And don't forget to join our Discord community linked in the description for even more insights. Thanks for watching, and we'll see you next time.